Something just broke in the global financial system, and almost no one in the US is paying attention. While most investors think the danger has passed, a hidden force is still unwinding beneath the surface, powerful enough to shake American markets in ways we haven't seen in decades. A few months ago, Japan's stock market collapsed in a single day. Not slowly, not quietly. It was violent, sudden, and the shockwaves didn't stay in Tokyo. They raced straight into US stocks, crypto, and global markets before most people even understood what was happening. Tech giants lost hundreds of billions. Bitcoin crashed in minutes. The fear gauge exploded to levels we've only seen during global emergencies. And yet the media completely missed the real cause. This wasn't a recession. It wasn't war. And it wasn't an AI bubble. It was something far more mechanical, something invisible to beginners, but terrifying to professional investors. For decades, the global market has been built on a single, fragile foundation: cheap money borrowed from Japan and deployed everywhere else. It inflated stocks, real estate, retirement accounts, and created an illusion of stability that most people now mistake for safety. And when Japan finally tightened the valve, even slightly, that entire system began to crack. In this video, I'm going to explain what the yen carry trade actually is in simple terms, why its unwind isn't finished yet, and how this Japanese black swan could quietly become the next major risk to US markets. But before we talk about what this means for your money, you need to understand why the most dangerous market risks are never obvious, and why by the time everyone sees them, it's already too late. Let's start there.
My name is Mac, and this is Mac Invests, where we make the market make sense for ambitious beginners. If you've ever watched a day where stocks, crypto, and safe stuff all drop together and thought, wait, how is everything crashing at once? This video is for you. Because what you're about to learn isn't a prediction, it's a mechanism. And once you understand the mechanism, you stop reacting to headlines, and you start seeing risk earlier. We're going to break this into 3 simple questions. What is the yen carry trade? Why can it shake US markets? What's the beginner-proof plan to protect yourself if volatility returns? No jargon, no conspiracy, just the machine.
Most people think market risk comes from bad news. A war headline, a recession print, a tech bubble popping. But a lot of the scariest market moves come from something more boring and far more dangerous: leverage and funding costs. Here's the easiest way to picture it. Imagine the global financial system is a city and money is water. When water is cheap and flowing fast, every building looks stronger than it really is. New projects start, prices rise, risk feels invisible. This cheap funding can create a false sense of security, encouraging excessive risk-taking among investors and companies. Companies often use financial leverage, borrowing capital to amplify returns, which can lead to significant gains but also magnified losses if investments sour. But if the water pressure changes, even slightly, weak structures crack first. And when one big structure cracks, it creates a chain reaction. That's what happened in early August 2024. A pressure change hit a funding channel that had been feeding global risk-taking for years: yen-funded borrowing. The Bank of Japan's policy shift led to market concerns and the unwinding of the yen carry trade, impacting global funding. The yen carry trade involves borrowing yen at low rates to invest in higher-yielding assets elsewhere. When Japan's rates rise, this trade becomes less attractive. This can trigger capital flow back to Japan, reducing global funding and increasing demand for Japanese assets, affecting currency and bond markets. The scary part isn't that Japan suddenly matters more than the United States. The scary part is that Japan has been one of the cheapest funding sources in the world for decades. When the cost to borrow yen increases and the value of the investment decreases, investors are forced to sell to meet margin calls. Changes in monetary policy, like interest rate hikes by central banks, directly impact funding costs and can trigger significant market adjustments. And when cheap funding changes, the entire risk pyramid starts to wobble. Understanding these deeper mechanical forces, like leverage and funding costs, is crucial for beginner investors to assess and manage risk in their portfolios. By looking beyond headlines and focusing on these underlying dynamics, you can gain a more robust understanding of market stability and potential shocks. Let's build the carry trade in plain English. For a long time, Japan had ultra-low interest rates. So institutions could borrow in yen at very low cost, convert to dollars, and buy higher-yielding assets. The logic looks simple. Borrow cheap, invest in higher return, pocket the spread. But there's a hidden risk: currency moves. If the yen strengthens, the cost of paying back that yen debt rises in dollar terms, even if your investments didn't change. So what happens when the yen jumps quickly? You get margin calls. And margin calls do one thing: they force selling. And forced selling doesn't care what you're holding. It sells what's liquid, what's profitable, what can be sold immediately. That's why in liquidity events, correlations can spike and diversification feels broken. It's not that every asset suddenly became bad. It's that everyone needs cash at the same time. Now here's the key. In late July 2024, the Bank of Japan raised rates to around 0.25% and signaled a path toward reducing bond purchases, a move markets interpreted as Japan stepping away from ultra-easy policy. Then early August brought turbulence, and the yen carry story suddenly mattered to everyone. But this isn't just about hedge funds. There's a second channel that can hit the US even harder: Japanese institutions holding and selling US bonds. Here's where the story gets serious for the United States. The US financial system runs on the treasury market. Treasuries aren't just investments. They're collateral. They're plumbing. They're the backbone of global finance. So when a large holder is forced to sell treasuries, it doesn't stay contained. It pushes yields higher, and it can do it very fast. In 2024, one Japanese institution became a clear symbol of this pressure. Norinchukin Bank, a major Japanese financial institution, announced plans to sell roughly the equivalent of about $63 billion in US and European sovereign bonds to stem losses. Now ask yourself this question: why would a conservative institution sell massive amounts of safe bonds? Because when interest rates rise, bond prices fall. And when you hold foreign bonds, hedging currency risk can become brutally expensive. As rate differentials widen, the cost of that hedge explodes. What looked safe on paper suddenly becomes a loss generator. And this is where an institutional problem turns into a market problem. Selling bonds pushes prices down. Lower prices push yields up. Higher yields tighten financial conditions. Tighter conditions increase stress. And stress forces more selling. That's the feedback loop. This is how a Japan story becomes a US market story. Not because Japan is attacking the United States, not because of geopolitics, but because in a leveraged world, funding costs and liquidity are the hidden gears that move everything else.
If you've studied markets long enough, you learn something humbling. Crises don't repeat perfectly, but they rhyme. When a trade becomes too crowded and too leveraged, it doesn't unwind politely. It breaks, often through forced deleveraging. We've seen versions of this before. Currency moves trigger margin stress. Positions get cut not because fundamentals changed, but because liquidity disappears. And suddenly the market isn't pricing value. It's pricing survival. That's the real lesson for beginners. You don't need to predict the exact trigger. You don't need to guess the headline. You need to avoid building a portfolio that collapses when funding costs shift and liquidity dries up. Because during liquidity events, the market doesn't ask, "Is this a good asset?" It asks, "What can you sell right now?" So the real question becomes, how do you set yourself up so you're not the one selling at the worst possible moment? That's exactly what we'll do next with a simple, beginner-proof plan. Here's the simple plan: no panic, no predictions. Reduce fragility first. If a 10% market drop would force you to sell, the issue isn't investing, it's structure. Build an emergency buffer. Keep monthly obligations manageable. Avoid high-interest debt that turns volatility into a crisis. Avoid hidden leverage. Many beginners take more risk than they realize through margin, concentrated positions, or all-in bets. In a liquidity squeeze, leverage doesn't just hurt, it breaks portfolios. Know your liquidity ladder. If markets get volatile, what do you sell first, if anything at all? That decision should be written down when you're calm, not when fear is screaming. Build a volatility mindset. If the yen strengthens and markets wobble, it doesn't automatically mean the world is ending. It means liquidity is shifting, and liquidity shifts create both danger and opportunity. Keep a watch list and a rule. High-quality assets often go on sale during forced selling events. If you're prepared, you can buy slowly and safely instead of panicking at the worst moment. And one more thing, this video isn't financial advice. It's education. But understanding this mechanism can save you from the most common beginner mistake of all, reacting late. If you want, I can follow this up with a beginner-friendly breakdown of the indicators to watch, like US dollar to Japanese yen moves and treasury yield stress, without turning it into chart wizardry. Subscribe, and I'll see you in the next one.